Hello class, today we're going to take a look at Chapter 5, Itemized Deductions, Learning Objective 1, Deductible Medical Expenses. And before we go through the deduction here for medical expenses, it's important to know that we're talking about itemized deductions, so below the line from AGI deductions. And often taxpayers will make a determination whether to take the standard deduction or to do what's called itemizing and go through and include these itemized deductions, one of which medical expenses can normally be deducted up to 10% of the adjusted gross income. It used to be 7.5%, but it's now 10%. And those deductions can be taken not just for themselves, but also spouse and dependent, provided that the relationship exists prior to those expenses being incurred or paid. So if an individual has surgery before getting married and pays for that surgery, that's not going to be, and then subsequently gets married, that's not going to be an expense that can be taken by the spouse for a deduction. And taxpayers can deduct just about all medical expenses as long as they're doctor prescribed, so not cosmetic surgery or something similar to that. But as long as it's doctor prescribed for medical purpose, then just about all of those expenses are going to be able to be deducted. The expenses related to maintenance of general health are also usually not deductible, so the checkups usually are not going to be deductible. And the deduction can only be claimed only for medical expenses paid during the tax year, and that's regardless of when care is paid. So this is going to be essentially cash basis, not accrual basis. And also, it has to actually be paid. So if insurance paid for the cost of the expense, it's not something that can be claimed as a deduction. Medical capital expenditures are going to be deductible only to the extent the expenditure exceeds the increase in the fair market value of property. And an example here might be if a chairlift is installed in the house. That chairlift being included in the house might increase the fair market value of the house. But to the extent it was costlier than the increase in the fair market value, that amount can be deducted. And you can also deduct transportation costs such as cab or bus fare or train fare, and some personal auto expenses, as well as the premiums for long-term care insurance to the extent to which it's dependent upon taxpayers' age. So let's take a look at our first concept check. Concept check 1. Medical expenses are generally deductible only to the extent they exceed blank of AGI. That's going to be 10%. Concept check 2. Medical expenses can be deducted only in the year the expenses are. That's going to be paid. Concept check 3. The deductible amount of medical expenses is reduced by blank and blank for those expenses. And that's going to be insurance reimbursement. So to the extent insurance pays for the cost of those expenses, that's not going to be a portion of the expense that can be taken as a deduction. Concept check 4. The cost of long-term care insurance premiums is deductible, but the extent of the deduction depends on the taxpayers. That's going to be the age. Learning objective 2, deductible state and local taxes. Now another deduction that taxpayers can itemize is state and local taxes. And there's 4 main categories for this: personal property tax, local real estate tax, other state and local taxes such as income tax and foreign taxes. Although many taxpayers will elect to take foreign taxes as a tax credit rather than a tax deduction. And individuals will deduct the state and local income taxes as well as property taxes such as real estate and personal property on a Schedule A when filing the 1040. This deduction is limited though for state and local taxes to $10,000 or $5,000 married filing single, based on the Tax Cuts and Jobs Act of 2017. And that $10,000 cap on the deduction is for income, real estate, and other state and local taxes. And as you can imagine, as some states may have many taxes and some states may have little taxes, it also creates a policy debate between residents of the various states. The real estate taxes are deductible in the calculation of federal taxable income. However, the tax must be paid on personal use real estate, such as a principal residence, then that is going to be able to be itemized, is able to be deducted as an itemized deduction on Schedule A. So what that's going to be is not your rental vacation home, for example. Also, the personal property taxes can be paid on personal use assets such as a family car, and they're going to be deductible on Schedule A, but that property tax must be based on the value of the property, levied on the property, and be imposed on at least an annual basis. And so what that's going to mean is not sales and use tax on personal property. Now, the individual taxpayer can deduct the amount of state income taxes actually paid. So the distinction here is between what's paid and what's owed. So regarding what's paid, that can include any payments through withholding, estimated taxes, or filing an amount due with the prior year's return. Because the amount paid may differ from the amount owed, it's possible that the taxpayer would receive a refund in the following year for the state taxes. And if that occurs, then that refund must be included as taxable income for the year of receipt. And the reason for that is under the tax benefit rule. So if you paid more than you owed, took the deduction, got the benefit of the deduction, so you don't get an excess benefit for federal deductions, you must similarly balance it out by taking it as income for refunds actually received. That way on the net, you're going to average out to the amount owed. Now in 2019, you can elect to take itemized deductions for the amount of either state and local income taxes or state and local general sales tax paid. And the reason here is that some states may have income tax for funding the state government, and some states may not. They may rely solely on something like a sales tax and sales and use tax. Either way, this tax paid that is going to be included in the amount for the deduction is still going to be capped at that $10,000. The amount of sales tax deduction can be paid determining one of two ways, either by calculating the actual sales tax paid during the year, so looking at receipts, for example. And another way is to use tax deduction tables provided by the IRS in the Schedule A instructions. And then there's also a deduction calculator on the IRS website where you input the information, and it takes about 10 minutes to complete. But either way, you can select either the tax tables as a way to determine that sales tax deduction, or collecting the receipts in the actual sales tax paid. Again, foreign tax paid are deductible. However, many taxpayers will elect to take that as a tax credit. And the reason is you're usually better off because the tax credit is going to be a dollar for dollar reduction in the amount of taxes, whereas the deduction is just going to be a reduction in adjusted gross income. Deduction is going to be a reduction from the adjusted gross income, rather. So the dollar for dollar would reduce the amount of the taxes by the amount of the foreign taxes paid. Let's take a look at a concept checks. Concept check 1, for personal property taxes to be deductible, they must be based on the value of property. That is true. Concept check 2, when property is sold during the year, only the seller is allowed to take the deduction for taxes paid. And that is false. Concept check 3, the tax benefit rule states that if a taxpayer receives a tax benefit when an expense is paid, no further action is required on the taxpayer's part if a refund is received in the future. And that is false. If an expense is paid and you receive the benefit by getting a tax deduction in the year in which the refund is received, you would include that amount in income. In concept check 4, the overall dollar limitation for the deductibility for state and local taxes is $11,000, and that is false. The limitation for deductibility for state and local taxes is going to be $10,000 or $5,000 for married filing single. Learning objective 3, deductible interest. And the itemized deduction we're talking about here is typically going to be your mortgage interest. It's going to be any interest paid on home acquisition loan, that is when you go out to buy the home, or home equity loan. So that's going to be if you go in and refinance it, or if there's equity in that amount. That is a $200,000 house, you had a $200,000 loan on it. You paid over the course of maybe 5 years, 10 years, $100,000 of that loan. So you have a $100,000 loan on a $200,000 property, and maybe you want to go and get a second loan to do a home improvement, like a new roof or something like that. So the second loan you get on the house would be this home equity loan. Interest on both are going to be deductible under these provisions. The aggregate amount of the debt, though, is going to have a limit on it as of beginning in 2018, and that's going to be to the amount of the debt cannot exceed $750,000. So we're saying for the mortgage interest deduction, no jumbo loans here. So, and then again for the home equity loan, home acquisition and improvement indebtedness can be for the loan principal and the home equity loan, as long as the loan proceeds are used for those purposes. So it's what are the purpose of the monies received on the loan is how we're judging this. Now, as far as that $750,000, the IRS had taken a position that was going to be for an individual resident, so a house could not be worth more than $750,000. However, the Ninth Circuit Court of Appeals ruled several years ago that is going to be for an individual. It's based on the tax filer. So if you have two unmarried individuals that go in together to buy a $1.5 million house, each individual can use the interest paid on their portion of that mortgage as an itemized deduction. So you can have $750,000 for one individual that is co-owner of the property, and $750,000 for another co-owner of that property. And similarly for the home equity interest, as long as it's used for that purpose of improving the house, the interest on that would be included as well as a deduction. So when a mortgage is taken out, there's something referred to as points that are paid. Essentially, if you had a $100,000 mortgage loan that was going to be taken, you could pay as the home buyer, say 2 points, which would be 2% times the $100,000 or $2,000 upfront on closing. And then you would have the ability to take those points over the term of the entire loan. However, you're also allowed an exception for points paid in connection with the principal residence. So another type of interest that's included here, in addition to the mortgage and home equity interest, is going to be investment interest. However, it's only going to be up into the point of investment income. So investment interest might be something along the lines of if you purchase stock on margin. So you have $1,000 that you're going to invest in stock, but you're going to actually purchase $1,500 worth of stock. So you're using $1,000 of your money and $500 of the broker's money to make this purchase. You would pay the broker interest on the $500 essentially borrowed. Essentially, it's a loan that you're receiving from the broker. You're allowed to deduct that interest, but only up to the net investment income that you're receiving through the brokerage account as well. And if you have investment interest expenses that exceed that investment income, what you're going to do is use it as a carry forward, so you can use it next year to offset net investment income. So let's take a look at a concept check here. Acquisition indebtedness means any debt incurred to blank any qualified residence, and that's going to be to acquire, construct, or substantially improve. Concept check 2. The aggregate amount treated as acquisition indebtedness for any period cannot exceed blank for married filing jointly, and that's going to be $750,000. And remember that for married individuals filing separate returns, it'll be $375,000 per individual. However, unmarried couples pooling their money and going in together, we get $750,000 per person, not per residence. Concept check 3, the deduction for investment interest expense is limited to blank income for the year. That's going to be net investment income. Any investment interest expense above that amount is going to be taken as a carry forward for future net investment income to offset it. Concept check 4, each point paid to acquire a home loan equals blank of the loan principal. And that is going to be 1%. So 1 point is equal to 1%, and it's essentially prepaid interest. Learning objective 4, deductible gifts to charity. Now, charitable giving has traditionally been an itemized deduction to public charities up to an AGI limit of 50%. The Tax Cuts and Jobs Act of 2017 changed that limit, increasing it to where tax filers now can include as an itemized deduction these charitable givings up to 60% of their AGI, or up to 60% of their adjusted gross income. Another change that was made, though, is regarding payments made to educational institutions, such as like a university. Previously, tax filers would be able to take as a charitable deduction payments received in which they received a preferential benefit. So something like preferred seating at one of the university football games or something along those lines. Now, under the Tax Cuts and Jobs Act, that is no longer going to be able to be taken as an itemized deduction. Now, these charitable deductions, when taken as itemized deductions, are going to be included on Schedule A, and the amount is going to be dependent upon the type of donated property, and is going to be need to be either cash or some other property of value. Now, depending on the nature of the property, is going to determine whether or not the percentage the percent limit up to the adjusted gross income is going to be 60%. So here, charitable contributions to public charities are going to have that 60% of adjusted gross income. However, if we're talking about appreciated capital gain property, so something along the lines of investing in a stock for $1,000, it's now worth $3,000, and you want to give that $3,000 stock to as a donation, you're going to get a 30% of your adjusted gross income limitation based on that appreciated capital gain property. And then also, instead of a public charity, if it's a private foundation, and there's certain rules that these organizations need to comply with in order to be characterized as a public charity or a private foundation, but if the organization you want to donate to is categorized as a private foundation, and what you're wanting to give is that capital gain property, it's going to be a 20% of your adjusted gross income limitation is going to be the maximum amount you're allowed to include as itemized deductions for that charitable gift. Now, generally, the way the appreciated capital gain property would be taken as an itemized deduction. So, for example, the $3,000 stock that was purchased for $1,000 is going to be the fair market value of the property, so $3,000 in this example. And then there's a couple exceptions to this to where you can't include the fair market value. One of which is if the donated property is going to be put to an unrelated use. So an example here might be donating a car. As long as that car is used for transportation, then it's going to be a related use. It's going to be what it's used for, and you can still take the fair market value. So if it was $1,000 purchased for the car and it was worth $3,000, then you could take $3,000 as your deduction. However, if it's going to be put to an unrelated use, if you're essentially donating it as scrap metal, to where it's just going to get melted down, then the contribution is going to be reduced by the amount of that gain to what the fair market value as scrap metal would be. So if you could sell it as scrap metal for $1,200, and it was that's what it was going to get used for, then the maximum itemized deduction would be that $1,200, and then it's going to be only the reduction to the long-term capital gain. So if it's worth $800 as scrap metal, but you paid $1,000 for it, then you can still take $1,000 as that itemized deduction. So the second exception is going to be if it's short-term property, so held for less than a year. And if that's the case, it's going to be the tax basis of the asset is going to be what the itemized deduction is going to be taken as. So in the example before, the $1,000 cost. Now, as far as verifying the amount of charitable contributions, there's going to be dollar thresholds that are going to change what the thoroughness of that verification needs to be. So from a taxpayer's perspective, if you have less than $250 in charitable deductions, for example, if you had gone to Goodwill and provided them a bunch of old furniture and clothing perhaps, you can up to $249 just use a receipt. And that's typically given at an organization like that. If the charitable donation you're wanting to take as a deduction, if you have greater or equal to $250, you're going to need a written acknowledgement. So if you give $250 to your local food bank, then you're going to need them to say thank you for your donation of $250 in writing, and then you can include that as verification. Now, if you have a charitable donation over $500, you're going to also need to include the Form 8283, which is going to list that property out. So an example is if you're donating a car, you may need to include the Form 8283 and include the vehicle identification number for that donation. Let's take a look at our concept checks. Concept check 1, depending on the type and amount of a charitable donation, it can be claimed either as a 4 AGI deduction or as an itemized deduction on Schedule A, and that is going to be false. Concept check 2, the overall limitation on the deductibility of charitable contributions is 30% of AGI, and that is going to be false. The overall limitation is going to be 60% of AGI, but 30% is regarding appreciated gain property. Concept check 3, if non-cash gifts are worth more than $500, the taxpayer must file Form 8283, and that is true. Learning objective 5, deductible casualty and theft losses. Now, the Tax Cuts and Jobs Act of 2017 also made a significant change to the way personal casualty is deducted. Specifically, it's only permitted as an itemized deduction now if the loss is attributable to a federally declared disaster area, and that designation needs to be made by the President. So what's an example of casualty? Casualty is going to be an identifiable event such as sudden, unexpected, or unusual nature. And that's going to mean not gradual or progressive. So here, what we're talking about is yes for a hurricane, no for climate change. And in order to be a deduction, the taxpayer must own the damaged property, and the uninsured loss is calculated by taking the loss due to casualty minus the insurance recovery. So if there's damage to your roof, for example, it was insured and fully recovered, then you're not going to have excess loss here. So you don't take the amount that the insurance is covering. It has to be the uninsured portion. Now, generally, the casualty loss is going to be the lesser of either the fair market value immediately before the casualty reduced by the fair market value immediately after the casualty occurs, or the amount of the adjusted basis determining the loss from the sale or other disposition of the property involved. So the second one might be an issue where you bought the property cheaply. Now, when you're able to take this deduction is going to be the tax year the casualty took place typically. And there's going to be a couple instances where it might be a different tax year. One might be for a theft loss, another might be reimbursement by insurance or otherwise, and then the third might be disaster area losses. Now, the losses must be attributable to that federally declared disaster area, and it must be designated by the President. The deductible amount is limited, so each separate casualty is going to be reduced by 100. So if you have a second loss, that loss must be first each separate casualty is reduced by $100, so the second casualty would be reduced by the $100. Additionally, the loss must be in excess of 10% of your adjusted gross income, and this is going to be a test, not a threshold. And then casualty losses are going to be reported on that form 4684, and the net loss is carried to the appropriate form. Let's take a look at concept check. Concept check 1, a casualty is an identifiable event of blank nature. It's going to be sudden, unexpected, or unusual. Concept check 2, casualty losses are first reported on form That's going to be $46.84. Concept check 3. The tax law places blank limitations on personal casualty deductions. One is that each separate casualty is generally reduced by blank. There's going to be 3 limitations, and the separate casualty are going to be reduced by $100. Concept check 4. To obtain any benefit from casualty loss, the loss must generally be in excess of blank. That's going to be 10% of the adjusted gross income. Learning objective 6, other itemized deductions. Now, beginning in 2018, the previous category of miscellaneous itemized deductions subject to a 2% adjusted gross income limitation is going to be totally eliminated. In its place is just going to be other itemized deductions. And let's take a look at what that is going to be. So there's going to be restrictions that limit the amount of those deductions. One common example here is going to be gambling losses. But it's only to the extent of gambling winnings being reported, and that's reported on the Schedule 1. So an example here would be if you won, say, $1,000 playing the lottery, but not attributable solely to luck of buying a lottery ticket, but maybe you bought, say, 200 lottery tickets for $1 a piece. So you've got $1,000 in winnings, $200 in gambling losses. So you are able to take the $200 loss that you incurred up to that $1,000. So only reporting a net gain of $800 on your gambling winnings and losses. Additionally, the casualty and theft losses of income-producing property. Let's take a look at concept checks here. Concept check 1, the sum of all other itemized deductions must exceed 2.5% of the taxpayer's adjusted gross income before receiving any benefit. That is false. Concept check 2, gambling losses are an example of an allowable other itemized deduction. That is true. Concept check 3, an example of a deductible other itemized deduction would include the blue suit needed by an accountant for his job. And that is going to be false.